Okay, so this one, part 6, is the balance sheet. So cash debt. I do not like to see companies with a lot of debt and no cash. Of course, I mean, that's just ugly, right? Because that's what you're looking at, a potential bankruptcy situation. But a lot of companies they don't mind having debt. So you'll see companies with 100, 200, 300, all the way up to $1 billion in debt. And they tend to, and they never get rid of it. It's always on their balance sheet. They always have debt. And then they'll keep cash as well, 50 to 100, 200 million in cash, but they'll always have a net debt scenario. I don't like that. I want to see a net cash scenario. And ideally, I want to see no debt and a lot of cash. I want to see companies that have 100 million in cash and no debt. That's an ideal situation. It just gives them a strong balance sheet, and they get rewarded. Their share price gets rewarded. And if they do have debt, I want them to say, we're going to pay this off in 3 years. I want them to literally say that. So that we're cash focused. Yeah, we're going to borrow $200 million to build this mine, but we're going to pay it off in 3 years. That's what I want to see. I want to see a company that's cash focused. Um, and the one thing about balance sheet is these companies, they can go bankrupt. If they're losing money and they have a lot of debt on it that they have to finance, or that they have to pay off, the company has $100 million in debt, 10 million in cash, and they're only producing 50,000 ounces a year. That's not a good scenario. That's a company that could have problems, and that's a company that's going to get hit. Their share prices are going to get smacked. So, and you got to really watch that balance sheet. And in my book, I talk more about what to look for as far as the coverage ratio. It's like once you get over 50% net debt, over 50%, that's not that's not good. So you got to look for kind of what the what the levels are. But okay, current liabilities. Look and see if the current liabilities are higher than their cash level. I don't like to see that. So you have a company that's got, 20 million in current liabilities, and then they got, 10 million in cash. That's a big problem. You can also look at, total liabilities versus cash, but I kind of like to look at the current liabilities. You want the cash to basically be like 5x current liabilities. So that's something you just to pay attention to. Convertible debt. This is often hidden because when you look at their overall debt versus like their overall share structure, because convertible debt can basically dilute shares if they have a lot of convertible debt, and that dilution is kind of it basically it's an overhang on the value of the company if they have a lot of convertible debt. I don't like to see a lot of convertible debt because that's just dilution ready to happen, especially when companies go up in value. So you're investing in good companies, right? So they go up in value, and then they shareholders will convert that into shares. And yeah, the debt goes away, but the dilution's forever. That's the problem with convertible debt. I would rather have regular debt, that way we don't dilute shares. Use debt for leverage and then pay off your debt and keep your share structure low. Options, warrants. Okay, so um, I guess I give you a quick definition of both, right? So options are given to uh, you know, basically usually given to management, given to employees or third parties, whereas warrants are um, basically give people the option to buy shares. So whenever they do a financing, they will give you free warrants. And then the warrants are the ability to basically buy the shares back. And so the combination, both of these are at certain levels. So when you give somebody options, you can't give them at the current share price. Same with warrants; they're always at a future price. So if the current price is $1, the option has to be higher, like a dollar. I don't know, I mean, $1, and they're basically usually into the future, like $1.10, $1.20, $1.30, $1.40 if the current share price, and then they expire. At a certain point, they'll expire. So if the share price doesn't go up above that, then they can't turn these into shares. Sometimes the options they will not vest. So if they'll give options to like the board members or the managers or employees, but they won't vest for like 2 years. So we'll give you options at $1.10, but you can't, even if the shares go up to $1.20 this year, you can't convert them into shares, not until they've vested. And then so they have expiration and they have and then they have vesting periods as well. Um, Same with warrants, but you need to add all of these up to get your fully diluted shares. And if they turn into money, they will turn into cash because they turn into shares, right? And then investments. So the investments, these are when they hold shares in other companies. And I say these are often liquid because the investments in these other companies are shares. A lot of companies will own shares in other companies and they can sell them. And a lot of times those aren't, you have to look and see, those aren't usually aren't part of their cash balance. So you have to make sure and add up, how many shares they hold of another company, because that really is, it's liquid. They can sell those shares. Okay, free cash flow income. Um, bum, bum. A company with debt and no income has high risk. I think I mentioned that earlier when I was talking about the cash debt. Uh, Ideally, you do not want to see an exploration company with debt. Um, so free cash flow is only going to be from a producer. And so when you're a development story, you generally, or an exploration, unless you have an NSR or some type of cash flow coming in or some type of income coming in, you can check to see, do these companies have any free cash flow or any income? To know if they do not, then they're going to have to raise money. So you have to pay attention to that. Do they have any? And then that's something to look for as far as the balance sheet goes. The cash flow multiple. Um, so you want to look to see what the company is currently valued at, and I have that in on my website. It actually shows you the current multiple and the future multiple. Um, and so most of these companies are going to be valued somewhere between 3 and 20, actually all the way up to 3 and 30 with some of the royalty companies. Some of the lower ones, the three multiples, they usually don't go much lower than that. Most companies get valued at least 5, but you will see some go down to 3, and that's because of the location where they're at and their balance sheet and the life of the mine. So if you have a short life of mine, a lot of debt, high cost, your cash flow multiple will drop. So, and so you want to look at that and see what they currently valued at. What's their current cash flow multiple? You want to know that. So a quality major will be valued about 20 times free cash flow, and a quality mid-tier about 10. And then a quality small producer is about 5, and your average mid-tier is going to be, around at least 5, I would think, the average. And the average major is going to be around 15, maybe a little less than that, the average again. So that's your cash flow multiple.